Global money is flowing back into China. Is it time to get in or get out? This is Inside ETFs and we're talking about China. After years on the sidelines, global investors are wading back into Chinese markets. Goldman Sachs says that hedge funds were more active in onshore equities last month than at any time in recent years. That's a stark shift from when many called the markets uninvestable. It's a dramatic turnaround for an economy battered by crackdowns and a property crisis. But the rally is starting to wobble and US-China tensions are rising. So has China truly turned the page or could it flip back? Let's ask Stephen Schoenfeld, CEO of MarketVector Indexes. So Stephen, China just posted its weakest growth in a year and stock bulls are scrambling to prop up a faltering rally. Is this really the time to be investing or a signal to stay away?
The story for 2025 so far this year was China disproving those who felt it was uninvestable and making investors who underweighted China reconsider. The Chinese market has outperformed almost all developed markets and the United States by more than double. And so investors can use this pause to reconsider how they allocate to China. We are of the belief that regardless of your political beliefs, that one must have exposure to China.
Meanwhile, China ETFs saw outflows for a second straight week as Trump's trade rhetoric spooked investors. Won't trade tensions always cast a shadow over China's markets?
In this administration, both with President Trump and President Xi, the power play around tariffs and economic strength is going to be a factor. We've seen the US market actually more affected by these trade jitters than the Chinese market. I do believe that given that the presidents are scheduled to meet at the end of the month, there will be some kind of modus vivendi. And for those who are not fully exposed to China, there will be an opportunity to increase allocations.
Well, some investors still carry deep scars from China's sweeping regulatory crackdowns that began in 2021. Is the risk of heavy-handed intervention really behind us?
I think when investing in China and any communist run country, there is always that risk. We've seen that before. However, you also have to look at the Chinese self-interest. Just this week, Chinese leaders are convening the final planning session for the 15th five-year plan. The five-year plan is no longer just a state directive, but it sets the tone. And the Chinese government is going to be not only encouraging investment in leading tech sectors, but is also going to be encouraging consumption, which will be a big change. I do think the Chinese self-interest in attracting capital and growing their economy will outweigh any heavy-handed regulation against foreign investors.
While the IMF says that China needs to scale back its industrial policies in its battle against deflation, do you see that happening and how should investors position around that?
Based on expectations for the new directives in the five-year plan, I think there will be continued emphasis on industrial growth, despite what the IMF says, with a heavy emphasis on leading tech sectors, but also, as I said, an emphasis on consumer spending. I believe strongly that investors need to look at China holistically. By that, I mean not just mainland China, but also Hong Kong, which has become increasingly an integral part of China. So a broad, diversified exposure to China is what I would recommend to investors.
So finally, Stephen, Chinese retail investors also dominate local markets after increasing the volatility. How does that dynamic affect foreign ETF flows and should it convert to long-term holders?
So I believe that Chinese retail investors can move the market in the short term, but the China institutional investors, the banks, the insurance companies are the real factor in the market, and they have been given de facto instructions to continue to support the market. For foreign investors considering allocation to China, the most important thing is to look at the relative size of the Chinese market and make sure one is not dramatically underexposed. In other words, I would recommend a neutral exposure to China despite short-term fluctuations.
That was Stephen Schoenfeld from MarketVector Indexes. Don't forget, you can watch more videos on Reuters.com.